Andrew, I do think it's a big problem. I think it's a real problem that high net worth individuals have. They think that having multiple advisors gives them some level of diversification, just like, having stocks, bonds, international, US equities. They want to have some type of diversification. And there's a myth that if I incorporate two or multiple advisors within my overall financial plan, then I'm adding some level of diversification. And I do think that's a hidden myth.
Yeah. But I mean, I understand it, because for many of the clients we serve and for a lot of individuals that face this challenge, right? I mean, they have worked really hard. They built, a liquid net worth of, 2 million, 3 million, 6 million plus. And those type of clients, they're like, I get it. They're like, hey, I don't want to quote unquote put all my eggs in one basket, if you will, because if I do that, that must present some risk. And so the idea of diversifying and using, a Chase or a JP Morgan advisor, using, another bank advisor, an Edward Jones, and trying to combine these advisors with a new one or a planner. It seems like the simplistic benefit of that is diversification. But I think it is a myth because what you and I see most frequent when those types of relationships happen is the goal of diversification becomes an added negative effect, especially with expense and miscommunication, completely missing the goal of diversification. So, yeah, it is a myth, and I mean, we've seen it with clients.
Yeah, we have seen with clients, and we saw it the other day. And before we jump right into it, just want to thank everybody for joining us again at the Asset Management Group podcast. Like, subscribe, share this video. Look back at some of our old content. We have a lot of good stuff. We talk about financial planning, wealth building, and today we're going to talk about really the hidden myth behind having multiple advisors. And we're in the midst of our tax planning season. It's probably the heaviest workload that we have throughout the year because there's a lot of clients that we're doing Roth conversions, we're doing charitable contributions, we're doing some back end tax loss harvesting. And what I came across last week actually was speaking with one of our clients. And, for the whole year, we've talked about possibly doing a Roth conversion for her. And one of the reasons why I wanted to wait until kind of the back end of the year is because we have a good sense of what her income is going to be, right? Between dividends, between her Social Security, and between other income sources that she has. By this time, we have an idea of like what her income is going to be for 2025. But, we handle all of her qualified money. She's only been a client for about a year. And another firm manages her non-qualified money. And when I was first introduced to her, I knew that there could be a potential issue with having two advisors working for her. But at that point, I didn't want to fight the issue too much. At the end of the day, if a client's trusting us with over $1 million of their assets, then let's just start the relationship. And then over time, I'm confident between you and I and our team that we will get the rest of her business. So that kind of gives you a little backstory, give the audience a little backstory of this client.
And I want to pause there before you go into one of the situations that I know you're going to bring up, and just kind of ask a few questions here. So, with your client, because I think other clients would relate to this, is they came in and ended up hiring AMG, essentially with part of their estate,
Yeah.
right? And the majority of clients that make that decision, they're really trying to just get a feel, a test drive, if you will, kind of get a feel of that experience to determine if maybe this is where I should be. And I think that's very common. It's one method of why, or one reasoning as to why people use two different advisors. I think that's one, and that is that maybe it's just I guess the uncertainty of the unknown. And so let's go try this out. I've heard it's a good thing. I heard AMG could be a good benefit for me. Maybe they do something different than the current advisor that I use. So I'm going to start with half. And so that makes sense. I think one question though, then this is the whole point I wanted to bring this up, where if you're that individual who is thinking that way, you really have to come back and figure out what your end goal, meaning what questions are you trying to answer and define to determine why you would actually go with one over the other. Because if your client and her metric of quantifying should I actually hire Mo fully is determined on performance, okay, well, not and that's not a bad thing. But if that's the goal, then your aim has to be at least relevant to the investment strategy of the other financial advisor, apart from even what you may think is best for her, right?
Yeah, good point.
Because if her goal is, hey, I want to use Mo, well, you're thinking, well, I want you to hire me, but with everything. And the only way that I can get everything is to be able to check off the questions that you have to make that decision. And your questions are, I need you to perform better than this guy. Well, if this guy's risk level is inappropriate, then you're stuck. Do you take less risk knowing you won't win, or vice versa?
Yeah. And that's a big question to ask as a fiduciary, because you have to do what's best for the client. And if you really take that fiduciary standard to heart, then possibly what's best for the client isn't taking all out risk, right? So that's a good point. They can come to a point where you have to really understand what the expectations are of the client so that you can match them, but at the same time, you take the fiduciary, stamp of approval to heart. And, we don't want to put our firm at jeopardy because we want to go into this competition with another advisor for returns when we're putting our client in the wrong risk category. But you're right. I mean, you're right. Those is one of the things that I think clients really do need to understand. Or whoever is in this dilemma or in this situation where they have two advisors, what are you really trying to gauge and measure? Um, but we came into this time of the year, and we discussed Roth conversions. And so before I gave her the recommendation of the Roth conversion, I said, "Well, send me over your most recent statement for your non-qualified money." And the reason I wanted to see that is because I wanted to see how much dividends she earned this year, and if there were any capital gains. So she sends it to me, and I'm looking through it, and then my eyes just, I mean, wider than you can think, because all of a sudden I saw $86,000 of realized capital gains this year, in addition to 20,000 of dividends. And my jaw just dropped, because one, I was fairly aware that she didn't know this. I knew this. And two is that same advisory firm also recommended that she do a conversion as well, but didn't include the fact that
Oh, they recommended to do a
conversion,
conversion
yeah, with me,
and didn't.
and didn't realize that, because all their analysis did not include this $86,000 capital gain nor the $20,000 dividend. All they included was her Social Security and her small little pension. And so I just, I had a conversation with her, and I said, "This is a problem. This is a real problem." And she actually has a CPA, so she really has three people working with her. CPA is a little different. So I had a conversation with her and the CPA, and her CPA jaw just dropped too. This is the second time that they've made significant capital gains that has a major impact in her overall plan. And so here we are, year end, basically, and our strategy of a conversion is put on pause and completely halted this year because of this unforeseen, I want to say, mistake that she didn't catch.
Yeah. So I want to kind of play devil's advocate here, right? As a viewer, not an investor, right? So if I'm looking into this story, I'm saying, okay, well, first off, my from the outside looking in, who is actually driving the ship here, right? You, like you mentioned, you have a CPA. This client has two different financial advisors, and then there's her, right? The life that she's living. And so, like, who is orchestrating the actual goal of a plan, or does she even have a plan? That's probably a good question to ask. um, and then also, like, I think from the average American investor, I think they can easily accept this defense of, well, you should, markets have done well. Doesn't hurt to take earnings off the top. So like, how do you defend that? Let's say, and I don't know, the full details of like what the other advisor might have said or if he said anything in defense of their actions, but like markets have been good. Why is this as big of an issue, knowing that she made money and took some earnings off the top?
Why is this an issue?
Yeah, can you explain maybe some of the challenges so that people understand?
Okay, so she's 69 years old. Okay, so one thing is she's on Medicare right now. So between her dividends, the capital gains, her Social Security, and her pension, it took her over the $106,000 of IRMAA. So because of this, now she has her income for this year is at 140,000, somewhere around there. She's single. So basically she's in the additional $185 that she has to pay for Medicare per month. So because of that, now her Medicare premiums are going to double.
Yeah.
So that's one challenge that we have.
So it's like the first like trickle effect type item that all of a sudden the government's like, sweet, more taxes, more cost of health insurance.
Yeah. That's one. You mentioned taxes. Okay. So if done properly, well, right now on a phone call with the CPA, just those capital gains alone with the dividends, she is on the hook. Her CPA did the calculations, I think, of $20,000 of taxes. Now, her way of paying those taxes would be to sell some of her investments to raise cash to provide the income to pay the taxes. So this is going to be another issue next year. We've done a we've done a good job in the markets, right? So they haven't done a good job as far as like doing any tax loss harvesting. So next year could run in the market more gains.
So
does that make sense?
Yeah. So obviously she now has this tax liability she hadn't prepared for.
Right.
And if she doesn't have the liquidity on hand, cash on hand in the savings account, checking account, whatever, right? The CPA's guidance is, well, you just need to sell more stock, right? And okay, so to your point, yeah, I would question, is there a harvesting strategy? All right, now this is absurd, okay? Because the reality is like, I look at our clients, right? We for our clients that have especially, reasonably sized brokerage accounts, right? We're deploying tax loss harvesting strategies within their brokerage account, right? It's just one method of tax planning that we do for our clients. So if you look at the majority, and I'm talking the majority, maybe all clients that have brokerage accounts that we are deploying harvesting within them, they literally are sitting at, some of them, significant losses from a taxable standpoint while capturing 15, 17, 18% year-to-date returns, right? So they're positive in performance relative to whatever risk metric they're taking, right? S&P 500, NASDAQ, whatever you want to call it. But the tax picture is lost. And the reason that is this year, and let me just, go back with me just for a second. So you go back to the start of this year, Trump comes out, hey, here we go. We're gonna push this agenda of tariffs. And as a result, when he lays his first goal out to the general public, you got media propaganda, you got stories, you got turmoil, you got uncertainty. Markets hate uncertainty. Investors hate uncertainty. Market falls significantly at the end of Q1, right? Well, so I would be interested to also go back in her statement and say, okay, when did they sell these investments? Because they actually had a huge opportunity
for sure
this year to sell the same investments, and instead of creating a $60,000, $70,000, $80,000 gain, they very well could have created a $40,000, $50,000 loss.
For sure.
Step the basis, and then yes, they would have positive performance today, but now they have a nice loss on the books that they can utilize, which would have supported a conversion, which would have supported the sale of other investments that have gains next year. They missed it.
They missed it altogether.
And so So this client, it goes back to that first question. I think this is where any individual that knows they need assistance in this world, when they're trying to determine who is best for me, you have got to you got to know the right questions to ask. And I remember when she came in, and she's been with us for how long now?
A year ago.
About a year, right? Okay. So you look back over the last 12 months, and I remember in the very beginning, if they correct me if I'm wrong, one of the reasons she came to us is because that firm didn't actually do a whole lot of planning, specifically tax planning. And she had heard that we did that, right? Well, so now how does she wrestle with that today? Because if it was, hey, I want to test you guys out, see if it works. Well, here's 12 months later, they've made a mistake. To me, there should be no more questions.
Be no questions, yeah.
The money should be moved. And the problem is if she doesn't, then it goes back to this whole, she didn't know what questions to ask to begin with to figure out who she was going to use long term.
Yeah. Yeah, because when you're faced with the responsibility of having multiple advisors, there is you have to realize that situation, someone has to drive that ship. Someone has to drive the coordination of these multiple advisor strategy. And ultimately the incentive is, there really is no incentive for the advisors to be quite honest, to drive the relationship with the other advisor. So it's you, the client, that has to make sure that both advisors or three advisors, how many advisors you have, are on the same page at least of what my goal is, what my plan is. So that whether you're the one communicating or you can bring them to the table and they communicate with each other, that someone is having a coordinated strategy around your overall plan, because those two advisors are going to be working in a silo, right? They have their own plan, their own agenda. I mean, if you think about it, managing qualified money and managing non-qualified money are completely two different things, right? You can still have the aim for maximum growth, but how you approach that growth is completely different, right? This is not an issue for qualified accounts or Roth accounts, because we can trade all day, every day until Sunday, but there aren't any capital gains. There aren't any earned dividends that you're going to pay taxes on an annual basis. You only pay taxes on a qualified account when you pull money out, and in a Roth account, you only pay taxes on the contribution. That's it. But on unqualified accounts, you have to worry about wash sales. You have to worry about short-term gains, long-term gains, dividends, whether you receive the dividends or they're just reinvested. So those are just four things I can think of right now that on a non-qualified basis that you have to worry about on I won't say on a daily basis, but at least on a quarterly basis of how you're investing and how you're trading those accounts.
Yeah, and it's obviously your client, right? I mean, she's in a bind.
Yeah.
Okay. I mean, it is what it is. There's nothing she can do about that now. Hopefully it's an experience that leads her to the reality that I should not be using two different advisors because we're on two totally different pages. And to our point, go back with like, what are reasons why people do this? Your client here, she was once again looking for something that her advisor didn't offer, and that was tax planning or tax strategy. And I think that's common. I think many individuals that we come across that are using an advisor, wanting to interview an additional firm, and are hesitant to move everything. Their tendency is that they're looking for something that they're not getting, right? Otherwise, why would you look? Okay. And the problem is if you're looking at a firm like ours, which is a holistic financial planning firm, basically, if you're trying to figure out what that means, it means that we care about all things that play a part of our clients' financial well-being, right? Everything. It comes to debt, it comes to cash flow, it comes to taxes and performance and investments and fees. I mean, you name it all, right? Estate planning, et cetera. So from our view, clients come to us because they know that investing is a part of what we do, but it's not all that we do. And actually planning is what leads everything. And they want that. But they look at their other advisor over here and all he's focused on is investment strategy, which is fine, but that's the expectation. That's what they do. And so the challenge is when you're trying to figure this out, You've got the advisor that does the planning, the advisor that's been who you've been with. And to me, in this scenario, it's a classic scenario where it just doesn't work. You can't build an effective cash flow plan. You can't build an effective investment strategy. You can't build an effective tax strategy. It's practically impossible unless those two individuals are definitely on the same page. The challenge is it's hard to be on the same page when one has a investment philosophy that's different than the other's investment methodology. So where does it work? Okay. This is something we didn't talk about, but it's just off the hip.
Yeah.
Our firm offers, like for many individuals or families, I'm going to say typically this is going to be your higher net worth family estate or family that really likes maybe self-managing or really likes the investment broker that they've used all these years, or it's a family member, but they're missing that planning piece. Well, I think a good time where that would make sense is to add on planning, but planning alone. Okay. It's like, as an example, with our firm, we offer investment management for clients that just want investment management. We offer planning, or we offer the suite of two together, right? Which is what majority clients work with. They take us on as a firm to do all the planning as well as the investment management. And so I think that's a scenario that could work. What do you think about that?
I think that can work, right? Because there's two separate objectives there. The planner or the planning firm is giving you a list of things that need to be taken care of, right? Almost like checklists, right? Okay, we need to, worry about this tax. If we do this conversion here, if we do this life insurance plan here, here's how we're going to handle long-term care, pay off your debt here, right? Putting together the game plan. And now you're taking that plan on the investment side and telling this investment advisor at the other firm, here's what we need to do. And they just execute based off that plan, right? And so that plan gets adjusted on an annual basis. And as long as you're following the strategy, everything works well. I can see that working.
So it's like we're basically providing a recipe.
Right.
We're saying, hey, look, your investment strategy is fine. What we're going to do is provide a little bit more clarity to the planning approach and the recipe of what everything needs to do in accordance to now all these different areas that we need to work within. And then you're continuing to execute. So I think that scenario works. What about, I had this happen to me literally yesterday, and I know this happened to you with this case we're talking about, right? So when there's not a defined head of who's like running the show, okay? A lot of times it kind of falls back to, I feel like this happens. The CPA feels empowered to then become the one that says, this is what you do, period, from a taxable standpoint. Okay. So before I throw you, I'll give you my example, right? Sitting with a client yesterday, great client, local client, uses a local CPA. I know him. Okay. Don't know him from a business standpoint, but I know him. I actually have a few clients that use him. Okay. He brings in his tax return from last year. And we're talking about tax planning, right? To wrap up 2025. And we're going through the whole shebang, right? We've already done our tax prep call. We've already built strategy surrounding what we should do. We've considered QCDs and conversions, et cetera. And he says, look, I'm going to be honest with you. I did my tax return this past year, right? To wrap up 2024. Like, she wasn't happy.
Ooh, okay.
And she said that she absolutely disagrees with the strategy that you deployed last year. Okay. Now, I'm not defensive by any means, but I think, okay, well, that's interesting, right? Obviously, she has a different perspective. We should know what that perspective is. And I agree that by all means, a planning firm, not an investor, right? Not just a stockbroker, not just your Edward Jones, your JP Morgan, your whatever, that anytime you bring up the term tax, they're going to say, oh, you should reference your tax accountant or tax specialist. Now, I'm talking about a planning firm. There has to be a defined group or individual that's running the show, okay? And that's not a pride thing. It's just there's some criterias that have to be met for that to happen. And so my response to him is I said, well, that's interesting. Obviously, we should figure out what her thoughts are before we do anything this year. I said, but let me just I'll go ahead and tell you what I think and why I think she's coming across from that direction. What I know that she doesn't know, and I am confident of this, what I do know that she doesn't know is the expectation of your life from a taxable standpoint, year over year, for the rest of your life. Meaning, does she know in 2037 what your tax liability will be? Has she pre-calculated the expectation of your conversion, meaning she would have to know your investment strategy to determine that? Does she know, I'm not conversion, your RMD. Has she been able to determine the cost of the RMD relative to the way in which we're investing your assets, assuming we do know conversion? Does she know whether or not you're going to do any type of charitable, qualified charitable donations? Does she know the impact of that RMD against the tax liability on your Social Security and or IRMAA? And I'm talking about 1 year. What about for the rest of your life? Okay, so the difference is not, her outlook is different than ours. We're confident that what we're doing makes sense because we've literally quantified the value of what we know and expect, assuming life is what it is today. Of course, if it changes, then we consider those changes and we continue to plan. That's why it's planning. Her outlook is actually not even so much forward as it is in arrears, meaning she's coming in 2025 worried about reducing tax in 24, right?
Right.
Because she's wrapping the returns up. Well, that's her outlook and that's her perspective. And it's nothing. That's their world. So I'm not knocking that. But does she really have the ability to speak to the value of a strategy and transaction today relative to the benefit it provides to the estate even 20 years down the road, or to them from a cash flow standpoint 5 years down the road, when her focus is last year's financials? Does that make sense?
Makes total sense. It makes total sense to me, and I think if the audience kind of like rewinds that and listens to it, it'll make sense to them, because you're right. I mean, CPAs are from my experience, are worried about in arrears, right? But in the end of the day, we're worried about the present. How can I lower your taxes today?
For last year.
For last
unless I mean, if you meet with your CPA before year's end, right. But the average retiree, they're not talking to their accountant till the
April. Yeah. So they're looking at things to do to reduce your income from the year before,
with transactions you must have already created because you can't do anything now.
It's right. And again, that's what planning is. Planning isn't just about what we're going to execute today. Yes, we're gonna line items, some things to execute for year end, but it's also what's the ripple effect? What is it? What are we doing in relationship to what your life is going to look like 5 years from now, 10 years from now, 20 years from now on a tax wise? And so, I think there is that disconnect from CPAs and true financial planners, true planners, because if you're a true planner, you're looking at the entire picture again. Years down the road, with some level of expectations of, where tax rates are going to go, what your life is going to look like, with some certain milestones that are going to happen. I think the two things that are mostly overlooked when I think of working with CPAs is the impact of RMDs. That's probably the number one thing that causes your Social Security to be taxed, are these forced distributions by the government, right? I mean, think about it. If you've done an amazing job investing, like you crushed it, right? That's a good thing in your 401k and your IRA. But the downside to that is you'll have massive RMDs you have to distribute, and even if you don't need the income, right? You can be because there's another myth that happens where when I retire, I'll be in a lower tax bracket. Well, maybe, who knows, right? Kids are out the house.
Maybe if you didn't save well.
Maybe
that's look, I'm being that's a punchline, but I'm not being mean, but it's true.
It's true.
But if you saved well, it ain't true.
It's not true.
No.
And think about it. If you're on Social Security, if you're fortunate enough to have, if husband and wife are on Social Security, maybe one of you are fortunate enough to have a pension, right? Even if it's a smaller pension, 10 grand, right? You've done a great job saving, done an amazing job investing, and all of a sudden at 73, all of a sudden you have $75,000 of new income, $80,000 of new income coming in, $100,000 of new income coming in. Now, what do? You may see yourself back in the same tax position as you were when you were working.
And then, of course, the what if scenario there is, what if, because it'll happen, you're married, and at some point in that same story you're giving us, you lose a spouse. Well, do you know what happens when you go from joint filing to single filing? It's like I tell my clients, look, we're going to make these decisions based off what we know to be true, but then we can throw these other what if scenarios on there and even see why we should do this at greater value, because you take an individual and that loses a loved one, and in that moment, their assets aren't changing. All right. So, which means that the RMD value is not going anywhere. It's still the same. But what did change is all of a sudden the taxation on Social Security, the brackets for combined or provisional income, your federal brackets have changed, right? Your standard deduction has changed. Like, all of a sudden, yeah, you're like, well, they shouldn't do anything because they're paying 22% or they're paying 12%. Well, yeah, at some point they're going to be paying 32% if you don't do anything for quite some time, and then the impact to the estate. The whole scenario there is just, there's nothing wrong, obviously, with having a relationship with a financial planner. There's nothing wrong with having a relationship with a CPA. In fact, we believe that the best combination that any investment individual or retiree can have is to have a healthy bond between the tax specialist and or CPA, along with the accounting firm if there is one, and the financial planner. Okay, and of course, if the financial planning firm is also doing the investing, great. But if you just have an investor, then you need to add the planning firm. And the planning group like ours should have the capability to speak to all those areas, meaning they should be able to pull a board meeting together. Which is exactly what we're going to do in this situation. Yeah. I don't blame her a bit. The truth is advisors make stupid decisions like this advisor with your client all the darn time, right? Throwing the client's money away, eliminating their ability to do anything from a taxable standpoint, right? Because of their stupid decisions. They could have done something in Q1, right? Created massive losses. Instead, they create massive gains. And the point is you got to have a healthy team. And just mixing to advisors because of your uncertainty is not the right decision.
Your plan, you have to have a plan, but your plan has to be coordinated. There has to be a strategic strategy of what you're trying to execute, not just on a given year, but as the years go on, looking forward. And someone has to spearhead it, right? Someone has to raise their hand and say, I'm going to take charge of what this plan is going to look like. If it's not you, the client, then again, you may be putting expectations on two other advisors that really haven't raised their hand to do that. And again, you could be paying more in taxes, you could be paying more in Medicare, you could just be paying more in fees. You could just be paying at the end of the day that you could have avoided all of the chaos, all of the disconnection, and have a true synchronized plan by having someone in charge.
Yeah.
And that's what we do here.
And that's well said. And just to put a wrap on that, what I would say is if you're an individual that's going through a life-changing event, which is typically the time when you're showing interest, you've sold a company and now you're like, I don't know if the guy I'm working with is the right fit or the lady I'm working with. If you're entering retirement, now you got to make this massive decision on your pension. And you're like, I don't know if the guy I'm using is right going forward. If you're in that place, slow down and ask the right questions. What services am I getting today? What services do I think I'm going to need in the next season of life? Is the individual I'm working with and the team I'm working with, or do I even have a team, are they equipped to be able to address? If you don't know, ask the questions you need to ask and see what results you get. And then if you are going to entertain another advisory firm, make sure that you're looking for a firm that's actually either going to fill those gaps from a planning standpoint, or you should definitely open up your mind a bit more to actually deciding who is the right fit for you. And I would say now's a great time. If you don't have your year end, right? And as I'm a big believer of resetting, looking at year-end review, right? What did I do well? What did I not do well in all areas of life? And then look at it 2026 and set some goals. This whole concept of like, I don't have New Year's resolution. I'm like, get out of here. Like, what? The whole goal is to get better, right? Better is the name. Don't, I have my own philosophy when it comes to aiming for perfection, but because there's only one perfect individual, and the sooner we can, okay, I'm not going to get into that. Better's the goal.
Yeah.
Right? And so now's a great time to figure out how you orchestrate 2026 in a better way.
Love it.
I do too, man.
Great way to end it.
Always a pleasure. So on to next time.
On to next time.